Hello and welcome to the October 2022 issue of the Zavitz and Sykora Financial Strategies newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joining with me today is my partner, Mark Zavitz. Today, we're going to keep things short and simple and give you a market update over the next 15 to 20 minutes, no financial strategies. So we're just going to cover what happened over the past month. So in our previous September update, markets had already started reversing some of the gains they'd made in the month of July into August and early September. And as we previously updated you, the initial jolt came from US Fed Chair Jerome Powell pivoting on inflation as he read the data. After our last update, as the September month progressed, we saw CPI numbers come in for August. The market was anticipating a month-to-month decrease of negative 0.1% of the CPI in the US. So a slowdown, basically. Instead, what we ended up getting was an increase of around 0.1%, as you can see in this. The economy tends to feel the effects of rate hikes, 3 to 6 months after they've occurred. So the rate hikes that we happen to see in the months of, March and April and May across the globe, were really just starting to work themselves into the economy. And an increase in inflation after these rate hikes spooked the markets. And the way the markets are reading this is that we're actually going to need to increase rates further than we expected into the future. So for fixed income and equity market valuations, higher market returns, higher rates means lower bond prices and lower short-term corporate profitability. What else contributed to our sell-off over the past month? Well, the British economy almost collapsed behind the unraveling of their defined benefit public pension sector. So the British defined benefit public pension sector is very similar to Canada's. It supports government workers and crown corporations in England and the UK. The way most public defined benefit public pensions work, DB pensions, is that they're managed on an actuarial basis, meaning they build portfolios that are typically lower risk or as low as risk as possible in order to meet the future expected pension payment obligations they have for the members. Canadian public pensions and DB pensions are basically managed the exact same way. In the UK, these pensions buy low risk bonds, bond investments in their plans. But instead of them being called Government of Canada bonds, they're known as gilts, which are the UK version of a Government of Canada bond. So what exactly happened and why did the British economy almost collapse? Well, the newly elected Conservative Prime Minister Liz Truss, at a time where the UK is basically or England especially, is in a double-digit inflation environment, announced that they're going to substantially cut taxes for the middle class and upper middle class and wealthy, around 4.5%. And, cutting taxes in an inflationary environment is not a good thing because what it does do is it stokes the fire. It's like throwing kerosene on a bonfire. And the way the market received this was extremely inflationary at a time where there was already record inflation, the highest inflation that the UK has seen in 40 years. So what happened? Well, this caused essentially a run on bonds. What happened is that public pensions own a tremendous amount of these gilts. They actually have an obligation to buy gilts to match the pension obligations. It's written in the public pension documentation. So essentially, it's a mandate that they have. And one of the ways in a low interest rate environment that these managers of these pension plans try to juice some of the returns they get from their low yield gilts is that they use leverage. Well, if all of a sudden the market is anticipating that these bonds, that interest rates are going to need to rise, then the value of bonds out of nowhere decrease substantially. And if you're leveraged, in order to cover some of those losses, you actually need to sell some of these bonds. So it was going to cause a run on government bonds inside of these pension plans. So what did the government do? the government came in and said, you know what, we're going to backstop the economy. And this is the first time in months that a central bank has come in and said, hey, like we're paying attention to what's going on in the public pension sector, and the government is essentially sabotaging our efforts here. We're going to come in and we're going to buy some of these bonds, and we're going to give you an effective and a good price, and we're going to stabilize the bond market. And the market reacted favorably to that. And this actually a little bit contradicts what's going on with other central bankers, specifically Jerome Powell, who for the past 6 months, when he's asked to give some opinion on the effect rising rates is having on the stock market and bond market, the way he responds is by saying, I don't really care what's going on in those markets. My main goal is to look at inflation. So markets overall across the globe really like that, especially obviously the UK markets. It stabilized their currency, which was also in a run, and more importantly, it stabilized their public pension plans. The good news is, and although we've kind of dipped, and I'll show you on our next slide, back to the lows, I want you to take the information that you're seeing on this slide and carry it forward to the next couple of slides. Because if history repeats itself, as we can see here on these charts, there's a very high probability chance that in 2023 and beyond, we have some amazing years in capital markets. And that means some good returns for your portfolio. In this table, there's a return of the major stock market indices of the US after we have a major market correction. So this is for the S&P 500, the NASDAQ, and the Russell 2000. As a reminder to you, the S&P 500 is the 500 biggest companies in the US, but they're all multinational. The NASDAQ is known as the Technology Company Index, and the Russell 2000 is the Small to Big Company Index in the US. So following bad declines, we typically see double-digit and triple-digit returns from the market 3, 5, and 10 years out. So at this juncture, the advice is sit tight. We've already made it this far. Selling and going to cash or a GIC right now, although it might feel like you're inclined to do so, it might feel like the right thing to do is almost always, or has historically been, suicide for the returns in your portfolio. Mark, anything you want to add here?
No, just the fact that most of our clients have hopefully 5 and 10 year time horizons, and particularly 3 to 5 years out, the returns are. We have a couple question marks with some of the later corrections because we don't have 3 and 5 year returns. But if we look at 3 and 5 year returns, except for the NASDAQ and the tech bubble, and we don't have any clients invested exclusively in the NASDAQ, all the returns are positive. So the probability of a positive return 3 to 5 years out after a significant drawdown in assets is historically anyways, has been 100%.
Yeah, it has. And it's always, you always get enticed, right? When you start to see these guaranteed returns of 3 or 4%, and it does start to draw some people in. But the reality is when the free market, the risk-free rate, which is basically a GIC, when it reaches that 3 to 4% level, it's typically, or has historically in the past decade or so, been the worst time to move to GICs, because what follows is the rebound, and the next 3 to 5 to 10 years out, some of the best returns that you're going to see in your portfolio if you would have just stayed invested. So the indexes, we like to just give you a quick recap of what's happened. This month, we decided to cover the year-to-date performance of the indexes. As you can see on this slide, the Dow Jones Industrial Average in the United States is down around 17%. The S&P 500 on a year-to-date basis is down around 21%. The S&P TSX is down only around 10%. So the Canadian markets are faring better than some of the major US indices and US markets, predominantly because of their exposure to energy. And the Russell 2000 index, which is smaller companies, has a little bit more risk embedded in it. It's down around 22% year to date as of today. On a month to date basis, not month to date, sorry, in the past month, the performance of the indexes, again, as we were seeing on our previous two slides, we have seen some of those returns from July come off. We did see more of a pullback up until the end of the month. However, since the beginning of October, the beginning of the new quarter, the first 2 days of October, first 2 business days of October, we actually saw one of the largest rallies we've seen in the history of the market. So the American indices, the ones that we were just talking about, specifically the Dow Jones, the S&P 500, and the Russell 2000, were up almost 6% over the course of 2 days. And when I listen to some of the talking heads speak to why that is, well, there are billions of dollars of institutional cash sidelined. So portfolio managers, a lot of the really smart people with the PhDs that run hundreds of millions of dollars of funds, a lot of them have some large cash allocations and are looking at the economic data and some of the CPI data and trying to forecast exactly when the bottom of the market is. And when we start to get some data that is bad, so some of the bad news, which is actually typically bad for the economy, but in this case, because we're in an inflationary environment, it's actually good news for the market. It means inflation's coming down. That's when we see these large rushes into the stock market. So it's not to say that I think that inflation is over, but I think that when it's clear that inflation is over, we're going to see this rubber band effect in markets where all this sideline money is going to rush back in, and we already saw it in July what can happen. Equity markets as a whole can go up around 10%, but we're going to see all of what we've gone down in the past year rebound, and then I think we're going to push forward to new highs extremely quickly. So if you're sidelined for that, if you're not invested for that, you're going to miss out, and unfortunately, that's going to really hurt your bottom line. Now, we do like to talk about bond markets as well, which is the safe part of your portfolio. And because inflation hasn't gone away, and we continue to see rising fixed income yields across the globe, we have seen us retest the lows. In fact, break some of the lows that we saw in July as yields have pushed higher. The good news about all of this is that our fixed income, which prior to all of this inflation was going to be yielding somewhere in the ballpark of 0.5% to 1%. So that was going to be the return of our safe stuff in our portfolio. Well, now that it's down 15, 16%, and the yields of the bonds are now, especially safe bonds, are somewhere in the ballpark of 3 to 4%. That means we can at least make something on our bonds, on the safe portion of the portfolio. Not to mention, if we're getting 3 to 4%, when rates eventually do start to fall, as they're forecast to do by the end of 2023, we're going to get a tailwind, as we had for the past 40 years, that's going to write off some of these losses and create a capital gain for our bonds. So I wouldn't be surprised if next year, safe fixed income in your portfolio, the bond portion of the mutual funds and ETFs that you own, I wouldn't be surprised if that had a positive return of 5 or 6%. Not only just the yield, but some capital gains baked in there as well. When it comes to commodity prices, gold, silver, oil, and others in the past month or so, gold's gone up a little bit. It's up from around 1717. Oil was in the mid 90s and it spiked, and that's really coming on the back of the OPEC news that just came out earlier this week, where they said that they're going to be cutting around 2 million barrels. Natural gas, which had spiked, it's come down from around $8 US to around $7. So there's a mixed bag here in terms of commodity prices. The big surprise, as I was just saying, was OPEC. Without getting into the economics of price elasticity of demand, if the world's producing somewhere in the ballpark of $1 million barrels of oil per day, which is roughly what they're producing right now. And we need 1 million barrels of oil per day. Every time we cut 1 million barrels, from what I've seen, it usually typically pushes oil prices up 5 to 6%. So if we're cutting oil supply by around 2 million barrels, as been forecast, we should expect oil prices to increase around 10%. So why would they be doing this? Well, it's not because they're greedy. It's because they actually expect, and this being OPEC, that the oil demand globally, because we're about to head into recession, is going to decrease somewhere between 95 million to 98 million barrels requested or required per day for the economy to function. So, they're kind of getting ahead of the curve. They're not being overly greedy, which is what we would initially expect. It's a balancing act. They know that if oil is too expensive for too long, although in the short term it lines their pockets, oil producing countries, in the long term it creates demand destruction. And demand destruction, I mean, we've already seen it through renewable energy sources, just means that it's a faster race to the bottom for non-renewable energy, which is natural gas, oil, and that's exactly what some of these economies need to survive. So it's a balancing act for them. It's not just greed when they do something like this. When it comes to gold and why we own gold in a portfolio, as Marcus stated before in the past, the reason why we like gold in your portfolio is that it's insurance in case we're wrong on everything and the economy is essentially in this downward spiral and inflation is out of control and we have some sort of a collapse. So it's insurance inside of your portfolio. But historically, again, even though gold has been a detractor in the past 6 months from a performance standpoint in an economy that looks to be in decline, gold has returned somewhere in the ballpark of 3 to 4% over the past 100 years. So it will be a positive contributor to your portfolio. We like it for its diversification properties, and we want to continue to own a sleeve of it if you're in a conservative or moderate portfolio, and a larger sleeve if you're in the very conservative portfolio. One commodity that I thought was extremely interesting to highlight that we haven't highlighted in the past was lumber and lumber prices. If you've done anything around the house over the past 2 years, or you've purchased anything made of wood lately, you've likely noticed how expensive it is, or the quotes that you're getting, how expensive they are. Well, the good news is that lumber prices have come down substantially, somewhere in the ballpark of 60% from their highs. So if you're looking to buy or do something that requires lumber, I expect in the coming months for those costs to come down even more. Any contractor that you're buying from or getting a service from, they likely buy lumber in bulk. So they likely have inventory that is currently at the highs, somewhere around here is when they purchased the lumber. So if you wait and if you can be patient to do that job and you wait a few more months, as a consumer, you'll likely benefit from lower costs if lumber stays around this price. And pivoting to our portfolios that we have our clients in, here's a breakdown of the asset allocations of the various models. The very conservative portfolio on the far left, that has around 50 to 60% safe stuff and around 25 to 30% stocks, which are the equity portions of the mutual funds and ETFs that are in your portfolio, right around to the growth portfolio, which has around 80% equity, 20% fixed income. So if you're in the growth model, you have roughly 80% stocks, which are stocks that are owned in the mutual funds and ETFs in your portfolio. And when I say safe stuff, that's bonds, that's fixed income, which are owned in mutual funds and ETFs in your portfolio. Overall, the returns of these portfolios, as we can see on this slide, have been better than the market. And that's because our portfolios are balanced. So they're a combination of both stocks and bonds. The very conservative portfolio on a year-to-date basis is down just under 11%. The conservative portfolio, which we've rebalanced many of you to, it's down around 14%. The moderate portfolio, and this is all after fees, is down around 14.74% on a year-to-date basis. and the growth portfolio is down around 19% on a year-to-date basis. Anything, Mark, you want to add with respect to portfolios?
Just the fact that perhaps it's an X slider too, but I was just looking at the performance short term. I guess I shouldn't be looking at short term performance, but the performance in the last month of the U.S. markets was down 2 or 3%, and I was very encouraged to see that our portfolios were only down about 1%. So it was good, very good.
Yeah. I guess, this is the last slide before we head to just the disclaimer that we want to show for compliance purposes. Your quarterly statements are going to be coming out for the month of September or ending September, and they're likely going to show portfolio values that look similar to, and the funds are going to have a similar return to what you saw at the end of June when you got your last quarterly statement. However, that being said, the returns over the past couple of days have been fantastic. They've actually, been somewhere in the ballpark for all of our models of between 2 to 4%. So if you take a look at your portfolios today, they do look slightly healthier than they did from the time you got your statement a few days ago or when it was printed a few days ago. And overall, we're doing better than the market because of our balance. And I think that over the next coming months, we may either see our complete bottom, or we've already hit our bottom, but we'll see our bottom in the markets, and that 2023, because markets are forward looking, are going to usher in some nice returns for our models, for all of our clients that are fully invested, and for anyone that's a market participant. With that, I'm going to end the session. Thank you so much if you've tuned in to hear our market update. Mark and I really appreciate it. And if you have any questions or concerns or want to book a review for yourself, please feel free to contact us or a member of our team. Thanks so much for tuning in.
Happy Thanksgiving, everybody.
Yep. Thank you.